Welcome to The Deep Dive, your shortcut to really understanding what's driving business today. We're jumping straight into ADT's second quarter 2025 performance.
Yep, we've looked through the numbers, the strategy talk, and there's quite a bit to unpack here. It wasn't just a standard quarter for them.
Exactly. We want to get into what really moved the needle, any surprises, and what it suggests for ADT moving forward. Let's do it.
Right. And this quarter showed some significant financial strength, plus real progress on their bigger strategic shifts. They're trying to be more than just the alarm company,
Okay, let's start with the headline numbers. Give us the quick snapshot of Q2 2025. Looked like solid growth and the cash generation. Wow.
Definitely. So first thing, their recurring monthly revenue, RMR, hit a record, $363 million. Now that's up 2% year over year.
2%, okay.
Which, might not sound like a huge jump, but for a subscription business, that consistent RMR growth, it signals really strong customer loyalty, a predictable revenue stream. It's like an anchor.
Right, that recurring base is key. And total revenue.
That's a bigger pop, up 7% to $1.3 billion. And adjusted earnings per share soared 35% to 23 cents. These figures really show their strategic moves are paying off.
And you mentioned cash flow. That often tells a clearer story, doesn't it? What stood out there?
Oh, absolutely. Cash flow was a major highlight. Adjusted free cash flow, and this includes their interest rate swaps, hit $500 million just through the first half of the year.
$500 million.
Yeah, that's up 38% from last year. A huge jump. And $274 million of that came just in Q2. Adjusted net income was $191 million for the quarter. Adjusted EBITDA up 7% to $674 million. It just shows the underlying business is really humming efficiently.
And customer churn, always important for subscriptions.
Yeah, customer attrition looks solid, 12.8%. That's actually down 1/10 of a point from Q2 last year.
Okay, so slightly better than last year.
Exactly. It was a little bit higher than the record low they hit in Q1, but still, overall, a very positive trend. They're holding on to customers.
Okay, strong results. So how did they pull this off? Management talked about several key drivers, these strategic priorities. Where should we start unpacking that?
Well, what's really interesting is it's not just one thing. It seems like a coordinated push on multiple fronts, boosting both the top line and profitability. The big theme was definitely executing on those 2025 strategic goals, basically optimizing and rolling out newer stuff.
Right, these new capabilities and offerings. Tell us more about those. You mentioned higher installation revenue earlier.
Yeah, so the ADT Plus platform is a good example. They're pushing it out through all their sales channels. And the key thing, more new customers are picking it. And they're choosing bigger systems, more comprehensive setups, and importantly, with fewer discounts. That's what's pushing the average installation revenue up towards $1,500 a unit.
$1,500, that's a big step up from a basic package, I imagine.
Oh, absolutely. It shows they're successfully moving a bit of market, customers seeing value in the enhanced features.
And what about that trusted neighbor feature? That sounds useful.
It really does. It lets customers grant temporary access to people they trust. The feedback's been positive, but more than that, installations that include Trusted Neighbor. They're seeing average installation revenue over $2,500.
Wow, $2,500, significantly higher.
Way higher than the overall average. It's now on over 10% of their main do-it-for-me installs. And they just boosted it with the Yale Smart Lock, the fingerprint one.
Yeah.
Adding convenience,
That definitely sounds like moving beyond just basic alarms. What about on the cost side? Operational efficiencies, are they using tech there?
Absolutely. Their remote assistance program is apparently a huge win. Around half their service calls handled remotely now.
Half, so no truck roll needed.
Exactly. Think of the savings fuel technician time. It cuts field service costs significantly. Huge for margins. And they're dipping their toes into AI for customer care.
Oh yeah. How's that going?
Pretty promising, it sounds like. 90% of customer service chats are handled by AI agents first. And nearly half of those get resolved without ever needing a live person.
Impressive.
Yeah, and now they're starting to roll out AI for voice calls too.
Yeah.
That could be another big step for efficiency and maybe even faster customer service.
Okay, shifting gears a bit. Let's talk partnerships. Big names involved like Google and State Farm. How are those playing out?
The Google partnership seems solid. Their Nest-Aware subscriber base crossed the 1 million mark. So clearly that integration into the smart home ecosystem is working well.
Good momentum there. But State Farm sounded a bit slower.
Yeah, that one's been tougher. They've got just over 30,000 subscribers through that channel, which is definitely below what they initially expected.
30,000, okay, not huge numbers yet.
Right. So they're actively redesigning how they approach it. The new focus is on people who are moving, relocating, but management was careful to say, look, even if this new approach doesn't take off massively, it won't materially hurt their ad budget or financial plans, kind of managing expectations there.
That makes sense. Does that slower ramp up with State Farm suggest anything bigger about challenges in scaling these kinds of non-traditional partnerships? Or maybe just a learning curve?
It's a fair point.
Yeah.
It definitely shows that not every new idea hits a home run right away. They didn't get into the why it was slow on the call, but yeah, it suggests they might need to tweak their strategies for channels outside their usual direct sales or dealer networks. It's probably a learning process, and the fact that they're willing to adjust or even walk away without major financial damage seems pretty disciplined.
Okay. And I saw they also did a portfolio acquisition, buying subscribers.
Yeah, that's right. Picked up about 50,000 subscribers for $89 million. Management called it a well-established playbook.
So they've done this before.
Seems like it. They targeted accounts in dense areas, good credit scores, and they even built in some protection against customers leaving shortly after the deal. They said the returns look similar to their regular dealer business.
And future deals like this.
They indicated the pipeline for these kinds of bulk buys looks stronger now. And interestingly, they said while they don't bank on upselling these new customers when they make the deal, the opportunity to upgrade them later definitely exists. So potential upside there.
With all this cash coming in, how are they using it? Balance sheet, shareholder returns?
Well, they've certainly been returning cash to shareholders. $589 million so far this year between buybacks and dividends. They bought back 12 million shares just in Q2 for $96 million.
Okay. And debt.
Leverage actually ticked down slightly to 2.8 times adjusted EBITDA. Net debt is around $7.5 billion, but their average interest rate is pretty efficient, about 4.4%. And they did something quite smart recently.
What's that?
They locked in commitments for another $550 million term loan, but at a really good rate, SOFR plus 1.75%. That's pretty cheap borrowing in today's environment. They plan to use that cash to pay off some older, higher interest debt due in 2026. So optimizing the debt structure, freeing up even more cash flow down the line.
Very proactive financial management.
Okay, looking ahead then, did they change their full year forecast based on this strong quarter?
They actually reaffirmed the main guidance ranges, total revenue, adjusted EBITDA, adjusted free cash flow. That suggests they're confident they can keep this momentum going.
No big changes there then.
Yeah.
But they did bump up their adjusted earnings per share guidance by 4 cents, now expecting $80.81 to 89 cents per share, mostly because they've been buying back stock, so fewer shares outstanding.
Got it. Any nuances for the next quarter, Q3?
Yeah, they did flag that Q3 adjusted EBITDA and EPS might be similar to Q2 or maybe slightly lower. And adjusted free cash flow will likely see a bigger drop sequentially, mainly because of about $70 million in higher cash interest payments hitting in Q3.
Okay. Bit of timing impact there.
Right. But importantly, they also mentioned they think they can handle any potential impact from tariffs within their existing full-year guidance. So confidence in their supply chain and cost management.
Okay, let's pull back. Big picture time. What does this all mean for you, the listener, maybe as an investor? ADT often talks about being resilient no matter the economy. How did that show up here?
That's a really important question, right? How does a company like this actually handle things like inflation or, maybe people cutting back? No one's totally immune, but that recurring revenue model, it's a huge buffer.
Provides that baseline.
It's exactly predictability. Management pointed out something interesting too. Nationally, fewer people are moving homes right now. That's actually a headwind for getting new customers because there are fewer chances, fewer bites the apple when someone moves in.
Ah, okay. Fewer move-in installs.
Right. But counterintuitively, it's a tailwind for keeping existing customers because fewer people are moving out and canceling service.
Huh. Interesting dynamic.
Yeah. They did say they're watching non-payment cancellations closely. Those have ticked up a bit, but they feel they have it under control.
So, managing the macrocurrents, where else are they looking for growth besides the core residential business and these bulk buys?
They're definitely not just relying on the traditional stuff.
Yeah.
While that core do-it-for-me professional install business is still key, they mentioned they're making changes to their DIY approach.
Ah, the do-it-yourself market.
Yeah, tweaking the go-to-market strategy, the product costs. aiming to compete more aggressively there by late 2025 or early 2026. So a renewed push into that more price-sensitive segment. Plus, the small business channel, they've got a new leader there, positioning it as potentially a third major source of new subscribers. And like we said, more bulk acquisition opportunities seem to be popping up, which was helpful this quarter when their traditional dealer channel saw a slight dip year over year. It really paints a picture of a company actively managing different growth levers.
Okay, that's a comprehensive look at the quarter and the strategy. Let's shift gears for our This Is Not Financial Advices segment. Time to put on our imaginary hedge fund analyst hats. Based on everything we've heard, what's an outrageous but plausible trade idea for ADT?
All right, let's brainstorm. Given that really strong cash generation, smart debt management, and how they keep talking about shareholder returns, here's a thought. A leveraged yield harvest play.
Leveraged yield harvest. Okay, unpack that.
So we know ADT is great at generating cash. We know they just refinanced debt super favorably. Getting that $550 million at SOFR plus 175 basis points is impressive right now. The trade idea is go long ADT equity. But not necessarily banking on massive growth, more viewing it as a cash king.
Right, focusing on the cash flow.
Exactly. And here's the outrageous but plausible part. You anticipate ADT initiating a really aggressive capital return plan, maybe a big special dividend, or drastically speeding up share buybacks way beyond what they're doing now.
Using that cheap debt and strong cash flow to just shower shareholders.
Kind of. Leveraging that optimized, efficient capital structure to basically transform the stock's appeal. The goal would be to attract a completely new group of investors, people laser focused on income and yield. If they pull that off, you could see the stock re-rate to a much higher yield multiple.
So the share price goes up not just on fundamentals, but because it suddenly looks like a top-tier dividend stock.
Precisely. It could drive potentially significant short-term gains, maybe catching current analyst models off guard as the market suddenly values it differently based on that massive cash return potential. It's about the market recognizing the sheer power of that consistent cash flow machine.
Interesting angle. A bit unconventional, but definitely plausible given the numbers we discussed. Okay, that certainly gives us something to think about.
For sure. It hinges on management deciding to really lean into that cash return story aggressively.
All right, that wraps up our deep dive into ADT's Q2 2025 earnings call. We've seen a company posting strong financials, executing on a clear strategy that embraces new tech, and managing its capital quite shrewdly.
And just a reminder for everyone listening, everything we discussed today is based on that earnings call information. It's purely for informational purposes, definitely not financial advice.
Absolutely. Always do your own homework. Talk to a financial professional before making any investment decisions.
Yep.
We hope this gave you a much clearer picture of what's happening at ADT. What really stood out to you? Are they truly transforming or just getting better at their core business? Let us know what you think. Join us next time for another deep dive.